Good morning. It is Chris, and it is your This Week in Real Estate. We hit a milestone that I think we all saw coming. It hit it a little bit sooner than we expected. I didn't expect to see this until probably next year, but we're there. We recorded the first average weekly 30-year fixed mortgage rate at 7%. The last time that we did this was in 2002. I think everybody remembers after 2002, we had a housing surge that built the housing bubble that we saw. The fact that it's at 7% doesn't mean that we're going to see the world crash around us. In fact, next week, we'll kind of talk about why we think it's going to be a correction, not a crash, because there's a lot more data that's come out about forecasts for 2023. And other information that I want to share actually next week. But I did want to talk to you about where interest rates are going and what is expected over the next 6 to 12 months. Interest rates are expected to continue to go higher. The Federal Reserve has stated, based on the September jobs report and some other data that has come out that is showing still a favorable strength in the economy, that they want to slow the economy down. And in order to do that, they're going to raise rates again. It'll be another 0.75%, which has been stated as the most likely scenario. But they've also stated that December is also going to have a record 5 times in a row of 0.75% interest rates rise. So the Fed is really taking this inflation risk very seriously because we have to get ahead of it. High inflation can be more dramatically effective of our economy than causing a little bit of a recession. And that tends to be what most of the prognosticators are saying, is that we will have a mild recession that will probably last for less than a year. And we will then start moving out of that. And the good news, and the reason why I want to talk about 6 to 12 months, is yes, we will probably see rates approaching 8%, especially with the news of the two interest rates raises that the Fed is doing. The 10-year bond, which is what interest rates tend to follow most closely, topped 4%. And that is, again, almost 20-year high of the 10-year bond. So we expect to have rates continue to increase. However, the 10-year bond and the 2-year bond are in an inverted yield curve where the 2-year is actually paying more than the 10-year. And the reason for that is that the people view that we're going to have a harder economy in the next couple of years and a more sustainable economy long term. And that's why we expect to see a slight recession next year, and then will cause rates to drop next year. And that's why the 10-year is lower than the 2-year. If you have any questions on this, of what we expect to see in the second half of next year for rates, please give me a call. I'd love to talk to you about ways to strategically finance purchases today to take advantage of what we expect to see coming up in the next year or two. Thank you very much. Have a wonderful day.